I was asked last week, what is the one thing a startup can do to really impress you? And my answer is, teach me something I didn't know before. Show me some insight you have about the market. Excite me with a new challenge, a new opportunity. Give me some enlightenment. Give me insight. And that will get me really excited. I need to be just as excited by people who are themselves just as excited about building the business as they are about building the product. It means that the founder needs to be building the business and the business strategy into everything he or she does, not as an afterthought, not as finally finding a partner, but this needs to be from the get-go. How am I going to make this work? How am I going to create a market winner? How am I going to pay back my investors? How am I going to reward my team? How am I going to be able to grow fast, become a major presence in this industry? Not just with a great product, but with a great team and with a great outcome.
Welcome to the Invisible Inc. podcast. I'm your host, Shubha Chakravarti, Chief Financial Storyteller at Achieve. Our guest for today is Dr. Ron Weissman. Ron is a venture capitalist and angel investor with more than 30 years of experience in high technology investing and management. He's the chairman emeritus of the Angel Capital Association, and for the past 19 years, Ron has been chair of the enterprise software and AI group at the Band of Angels, Silicon Valley's oldest technology angel organization. He invests in AI, analytics, health IT, and vertical market software, and across a wide variety of deep tech industries. He spent 17 years as a partner at Apex Partners, a global VC and PE firm, and has served on more than 40 private company boards. He's also one of my most valued mentors and advisors. Now, here's Ron. Welcome to Invisible Inc., Ron, and we're so excited to have you here today.
It's a pleasure to be here.
So I've been meaning to have this conversation for a long time, so I've got a long list of topics lined up. But before we get started, I have to ask you about the story where you worked for Steve Jobs. Is there something that you'd like to kick us off with in terms of your most memorable experience?
Well, Steve was absolutely the best critic I've ever seen in the world, but this was generally about everything. So imagine the scene. We're opening our research center affiliated with Carnegie Mellon University in Pittsburgh, and Steve had a terrible U.S. air flight, and he's standing up at lunch to talk to the leaders of the Pittsburgh business community. And he said, if you want to be a first-class citizen, you need to have a first-class airline. And that was probably the worst opening comments I've ever heard from a keynote speaker.
And what was the reaction?
But he redeemed himself by looking very seriously at some of the best technologies coming out of Pittsburgh, which were truly magical. In fact, much of our operating system came from Pittsburgh. So all ended up well.
Great. That's a fantastic way to start. So you've had tremendous experience across the entire early stage industry. You've been a VC, you've been an operator, an angel. What has been the single biggest theme that has kind of come up across all of these experiences?
Well, let me mention the theme I'm going to be using throughout today's conversation. And that is, I need to be just as excited by people who are themselves just as excited about building the business as they are about building the product. And that's kind of like my core investment theme I've been pushing recently.
So walk me through it. What does that mean in reality when you're talking to a founder?
It means that the founder needs to be building the business and the business strategy into everything he or she does, not as an afterthought, not as finally finding a partner, but this needs to be from the get-go. How am I going to make this work? How am I going to create a market winner? How am I going to pay back my investors? How am I going to reward my team? How am I going to be able to grow fast, become a major presence in this industry? Not just with a great product, but with a great team and with a great outcome.
And how is that different? You said that's going to be the theme today. Has that evolved over time? Has that changed?
Well, there's lots of change going on right now in the early stage community, and there's a lot of change going on in the overall economy that's impacting the early stage ecosystem. So right now, it is very hard to get a job. If you're not a credentialed AI wizard, I think that some of the leading hiring companies for talent are hiring about 25% less this year than they had in the past. And what this means is there are a lot more startups out there because people are saying, hey, what the heck? I might as well realize my startup vision. But that means that many of those people are unfamiliar with having run, let alone built a startup. And so we have to exercise and explain the basics to them. I'm seeing a lot more first time, very inexperienced CEOs than I have in the past.
Is that a huge change or just a gradual change?
It's a pretty big change. We saw some of the same things happen in 2002, 2003. Certainly, we saw some of the same things happen in 2001, 2002. Good news is that angels did not hold it against brand new CEOs. In fact, there's been a steady increase over the past decade in angels funding of first time CEOs with no experience. So it's very good. At the same time, the quality of deal flow is not as good as it has been.
So, what does this mean for a first time founder who's now coming to seek their first outside funding round?
Have mentors, gain experience before you enter this world. Have business mentors who can help guide you. Think about finding a partner, a teammate who is your business founder from day one, who has had some experience building a successful company in the past.
Got it. That makes sense. And I want to start kind of digging into that a little bit in terms of the early stage funding landscape, right? I've heard you make amazing presentations before where you've painted a picture of what the early stage funding landscape looks like. So if you look at the landscape today for a first time founder who may not understand the difference between VC versus angels versus crowdfunding, how would you paint that picture so that they can think intelligently about the funding landscape?
Oh, I think one of the questions you also wanted me to think about was what's happened in the early stage landscape for the past decade. So let me answer the question that way. What we have seen, and I'm not sure this is good, but what we've seen is what I call the industrial model applied to early stage funding, where you go first, after friends and family, you go to an incubator or an accelerator, then you go to angels, then you go to early stage VCs, then you go to later stage VCs, and much of the groundwork is established by the incubators and the accelerators. On the one hand, I am seeing both less experienced CEOs, but CEOs who have been in this market for a while are more and more and more sophisticated. So an experienced CEO tends to know lots about venture, tends to know lots about angels and so forth, way more than the past. At the same time, this has led to a unbelievably boring set of pitching contests where everybody sounds the same, uses the same cliches, uses the same language, uses the same structure, kind of pitching by paint by the numbers. And so instead of originality, I'm seeing just a lot of very, very, very similar, very dull, very dry pitches. And so I think the industrial model has led to a foreshortening of creativity.
And what does that mean for you as, as the investor sitting on the other side? And therefore, what are the implications for me as a founder sitting on this side?
Right. So I was asked last week, so what is the one thing a startup can do to really impress you? And my answer is teach me something I didn't know before. Show me some insight you have about the market. Excite me with a new challenge, a new opportunity. Tell me something, as I said, I didn't know before. Give me some enlightenment. Give me insight. And that will get me really excited.
Basically, what you're asking for is domain mastery and insight into a specific corner of the market that is not commonly available.
Exactly. Not only domain knowledge, but direct participant knowledge, enough so that you have a pain point or an insight that I certainly wouldn't know because I'm not a market participant, but that you have lived through it and it's causing you to start this business.
So I'll just go back and think about some of the founders I've seen and worked with. So it's usually hey, I experienced this pain and I didn't find the right solution, so I'm doing this, which is like a typical, to me, it sounds like one of those boilerplate ways of introducing pitches that I've heard, which went against what you just said. Are there examples of founders that have done it well or aspects of that process that have gone well for you versus?
Oh, absolutely. One of my most memorable pitches ever was two guys who came to me and talked about the impact of earthquakes on mere mortals driving across a bridge, for example, and said, what if we could detect an earthquake 2 to 3 minutes before it happened? And I said, if you could do that, you could be saving lots of lives and really changing the trajectory of hundreds or thousands of people. We talked about that a while, and they told me about something I'd never heard of called P waves, which is a pressure wave that you can detect 3 or 4 minutes before an earthquake hits. And anyway, so again, they taught me something. They excited me. They gave me a different take on the world, as opposed to we're solving the dating problem for people from Afghanistan. And I love that. So teach me something new and different, and give me an insight into a piece of the world that I didn't know about.
So, okay, I can buy that. That would get you excited. How does that correlate to making a good investment, though? It could, I mean, I would argue that if the signs align, then the dating app and
Well, there's a long process after I get interested in a deal. We call that due diligence, but really is, it's 1 to 3 months of us working together to figure out how well your business strategy is likely to pay out. And this is about pattern recognition, since I've probably seen 20,000 prior deals. It's all about our learning how to work together, if we can work together. So I think it's kind of funny when a funder writes a check over a morning breakfast. We just met the startup, never having seen them before, because you're both missing that deep interaction, which might say, this is not an appropriate partnership, or it might say this is going to be a world-class partnership.
have
Yeah.
you seen examples where somebody met for breakfast and wrote a big check and have those worked out?
I don't like to say bad things about other people, but back in 2000, this was very common. Whenever markets pick up, writing those checks over breakfast becomes increasingly popular because of fear of missing out. I want to nail this one down right now. And having done no work on what could be some of the fatal flaws relating to the company and its markets and its team.
So I can understand the risk to the investor, right? You don't know who you're dealing with. But what about the founder who takes that check? What are the risks to him or her?
Well, first of all, investors come in all shapes and sizes. Some investors are extremely control oriented, and they have a vision for what you ought to be doing that may not be your vision. They may have had an idea in a prior life, and they want you to fulfill that. They may have a sense of markets that may have nothing to do what's good for you or for the company. So some investors can be really too hard-nosed and too forceful, and that's something to ferret out. Other investors can be the smartest guys in the room, and you don't want to work with them. Other investors can have a hidden agenda. There are some investors who pretend to be investors, but they're really, for example, they're really running marketing agencies, and they want you to use their marketing agency. So you need to do diligence on us at the same time we're doing diligence on you.
So on that point, what would you say is the single biggest mistake you see founders making in selecting their first investor?
Not really understanding what the investor's motivation are, or what the end game for the investor looks like.
So can you say more about that? What are they missing?
Some of the issues with investors, or if you're talking to venture capitalists, and this is more them than angels, VCs have invested via funds. Those funds have a 10-year life. Now, they can keep the fund going longer, but they have to basically say what they've done within the scope of that first 10 years. Did they achieve a 2x, a 3x, a 4x on their money, which is what they tell their limited partners? So if the VC is investing late in the fund, let's say investing in years 7, they're going to be pressuring you well before you had a chance to achieve metrics and milestones. They want you to exit so they can show return on capital to their investors. So if you don't know the mechanics of their fund, for example, are they investing in the first 3 years or the last 3 years? you may have a very, very bad outcome in terms of what the VCs have to do themselves.
And that's a great example. And I want to dive into the bigger picture, but on that specific topic, this is not something that's easy for a founder to find out, right? Like, how would I find out where you
Sure it is.
are in it?
You go on the website of the investor, and they typically list, when their funds started, or you can look at their press releases to say, okay, I'm investing in Happy Valley Fund 4. It started in, let's say, 2016. My God, it's the 10th year of the fund. They've started investing now. I'm toast. Or they raised the fund in 2024, which is great. That's all public knowledge.
You mean the LPs, right? Not the funds themselves.
The funds themselves.
The funds themselves. So you do the research on the funds and
by the way, about the first question you should be asking an EVC is, how old is your fund? When did it start investing? And they'll tell you.
So to take one step back, right? I've talked to a lot of founders where they seem to understand the VC world better than they understand the angel world. Can we just take a quick side tour and help, us understand the early stage funding landscape? You
Sure.
understand VCs. What's the difference between VCs, angels, and how should founders be thinking about who to work with as their first source of funding?
Okay. Well, the old joke is that VCs lose other people's money, that angels lose their own money. And there is a bit of a truth to that. Typically, we want to get paid for the risks we're taking. And angels are taking an earlier stage risk by and large than VCs are. So what angels are looking for is anywhere from, let us say, a 5x to a 20x on their money. And I can explain why those numbers work. Because we're taking early stage risks, the assumption is that most of our deals will fail. And we build that into our own computation. So when we say we want, let's say, a 10x from you, that's because we assume that 9 out of 10 deals fail. And we want a big multiple so that we can pay ourselves back for all the mistakes we've made. VCs have the same logic, although their failure rates are later stage, so they shouldn't be as dramatic as ours. So a VC may be happy with a 3x or a 4x or a 5x, where an angel is typically in the 10 to 20 to 30x range, given how many of our deals, because just of life instances, fail.
So you talked about angels, you talked about VCs, and of late, I've seen a lot of other participants coming up. So for example, specifically crowdfunding platforms.
Yes.
To what extent are these a real viable option for founders? And for what kinds of founders should be?
Okay, so if you have a physical product that needs to be manufactured, we all understand that you need a fair amount of working capital up front to do that. And crowdfunding provides that. Crowdfunding is best for tangible physical objects. If you're a software vendor and you're going to crowdfunding, you are probably going to disqualify yourself from raising follow-on funding, because for normal software businesses, if you can't raise money the normal way, why are you going to people who have no investment experience whatsoever and who are probably very, very naive and who cannot come back into your market in a 10-month, 12-month period because the rules of crowdfunding? Why are you doing this? You must not be very good. Physical products, entirely different.
So there's a clear bifurcation in terms of you have a physical product, particularly consumer facing, that somebody can touch and feel and have some connection to. That's clear. Then there's a bifurcation between angels and VCs. How should I make that decision? And what are the factors I should think about as a founder when I'm going the route of?
And that's a great question, because the answer does not quickly go to one side or the other. If you need money to grow markets fast, and you need introductions to the global leaders in your market or customer base, there's nothing like venture capital to help you grow fast. If you do not need to grow that fast, and you would want to maintain more control over your company, then angels are a great way to do that, because we take less. We'll take 15 to 25% of the equity, where VCs are going to start off by taking probably 51%. And that's why you can start out with 100% ownership, and by the fourth or fifth round, you as a CEO will be down to 8%, 5% of the equity. because every investor is going to want to further dilute the existing investors to maintain a decent stake in the company. So if you want to maintain control, particularly of a family style business, you do not want to work with VCs. On the other hand, if you really want a global domination strategy, you're going to need lots of capital to do that, lots of speed, and lots of high level introductions. Where you overlap is that angels can also make many of those high end introductions, but we're less onerous in terms of the capitalization structure we demand.
And is there a rule of thumb that you've seen working well or not working well in terms of how founders make that first decision? Because in what I've seen is founders, at least maybe the slice of founders that I work with, they seem to be more familiar with the VC space and a lot less familiar with the angel space.
That's very true. Angel investing, well, both VC and angel investing were black arts, old boys club kind of thing, where if you weren't part of the group, you had no idea how they operate. But we've seen the vast expansion of venture capital and the vast expansion of angel capital in the past decade. So in both cases, we're far less mysterious than we used to be.
So what advice would you give to a founder to try to, like, if they don't want to give up the control, they want to explore angels, what should they be doing and how should they be looking at the whole angel part of the ecosystem?
So one of my rules of thumb is that we're not talking about one simple term in a term sheet. We're talking about a whole package of terms, structuring a relationship between a founder and a VC or a founder and an angel. And so you want to look at all of that in the context of what's the relationship you want or need. Are you going to need continuous on-site support from the VC, from everything from building your team through building your network to finding your partners? Or are you pretty much convinced you can do much of that yourselves without the direct intervention of the VC? So how fast do you need to grow? How fast do you need to grow your networks? What kind of exit do you want? All of those things should color your decision about VCs, angels, or self-funding. I tell founders, do not take venture capital unless you really need it, because this is a devil's bargain. And I speak here as somebody who's been a VC for 30 years. We will control your life.
What does
You
that
just
mean?
signed your company over to us because we now have 51% control of the company.
Before we dive back into our conversation, I want to tell you about Seed to Success. Seed to Success is our community letter with our proprietary insights on startup financial storytelling, tips, new episodes, and much more. If you find these discussions helpful in your entrepreneurial journey, use the link in the description to subscribe to Seed to Success today and get all of these and much more straight to your inbox every week. Now, back to our conversation. To make this real for me as a founder, it's attractive to get a big check and all those connections you talked about to the market. What does that mean in terms of what I'm giving up if I'm going to go for VC money? Can you just talk about some tangible things that affect the founder's life and business?
No, if you don't perform well for 2 or 3 board meetings in succession, you may be gone. We control the hiring and firing of the team. And if we're unhappy with the performance of the team, we can simply go out and bring in a new team if we want to. I think, generally that's bad practice unless you really, really have to. But you don't have job security. You don't have control. The VC can second guess any decision that he or she wants to. The best relationships are built on trust, where we're working hand in glove together over the course of our 8 or 10-year relationship. But by the way, diligence, when you're doing diligence, you will get to know if you can work together. That's one of the things that an extended diligence period to help you with, as opposed to a shotgun marriage.
So it sounds like it affects your ability to operate and the degrees of freedom you have at a most foundational level. And obviously everything else is going to flow downstream from the fact that you essentially don't have job security, right? Or it's very dependent on very near-term performance against potentially
Absolutely.
aggressive targets.
You're only as good as your last board meeting.
Is that true? Is it really that bad?
Well, the VCs have put third-party money to work. And when the VC forms a fund, the top investors form the VC's advisory council. and they help guide the fortunes of the VC firm. They do things like approve extensions to the fund. And if certain partners keep doing bad deals, they'll be asked to leave by the VC, the elder VCs who are often strongly influenced by their advisory council. You got lots of people's money at stake. It's not just your decision to do what you want. There are rules of the road that must be followed.
And one more thing on this topic of you're as good as your board meeting, can you just talk about what are the kinds of things that if you're the board representative for your VC firm, what are the kinds of things you're evaluating the founder on?
Well, we're evaluating the performance of the company. Are we on track against the business plan? Are we on track relating to cash flow? Are we going to run out of money before the company has proven the milestones it needs to get to the next funding round or getting to profitability? It's things like that. How well is the team working together? Are they metrics driven? Are they detailed enough to worry about when things go wrong or when things go right? Are they understanding what success means? Who on the team has seen success before and is bringing those lessons learned back into the company? But lots of things, but mostly it's regular quarterly performance. And even before that, it's performance against plan on development, on building customer service, on building infrastructure. So we want the company to be well governed. And that means that decisions are fair and open and honest about the things that really matter.
So now I can see the difference between first time founders and experienced CEOs because the experienced CEOs have been around the block a few times. They know what to expect. Do you see a big difference in performance between first time founders who raise VC money versus repeat founders?
Yes. In fact, the most recent issue, I think, of the U.S. Angel Funders Report published by my organization, the Angel Capital Association, has shown now for the past several years that experienced CEOs have a higher success rate than first-time CEOs, enough so that difference really matters. Even so, on a national basis, angels are still every year investing more in new CEOs than they had in the previous period. So on the one hand, we know that experience matters. On the other hand, we're very democratic and want to give newcomers a chance to succeed as well.
And is that showing up in worse returns or is that just something?
That's no, in returns.
So it does show up in returns.
What kind of multiple did the company achieve at exit? Did they return the money that was invested? Did they return twice the money, 3 times the money, 4 times the money, half the money? And that's typically how success among angels is measured.
So
a lot less formally than the VCs. They're much, much tougher on how they measure success.
got it. So to the earlier question, you presumably will see a difference in returns between, say, first-time CEOs that you're funding versus the repeat CEOs that you're funding, right? And you mentioned
Yes.
that angels continue to fund first-time CEOs because they want to promote talent, whatever the case might be, opportunities. Are you seeing this persistence continue? And
Yes.
if so, are angels shooting themselves in the foot to some extent by doing that?
There's so much of deal doing involves personal chemistry, random activity, things that just happen. It's not a science. It's much more of an art. And much of it has to do with the chemistry between the CEO and the investor. This is true of all early stage deals. And there's no quantification for how you measure that chemistry. And so we may be very excited by the idea. We might realize that this person is a great engineering lead, but not a business lead. And we'll vow in the term sheet to fix that and say, you must hire a outbound business focused CEO. That won't stop us from doing the deal, though.
Got it. So I want to shift gears slightly. You talked about returns and how important exits are. I want to start off by asking what is happening in the landscape, the exit landscape, the IPO M&A landscape today that will impact significantly or is impacting how angels are viewing investments and how other early stage investors are viewing investments?
That's a excellent question. Well, outside of AI, and we'll deal with that in a minute, but outside of AI, the exit window has been closed for the past 4 years. Virtually no major exits outside of AI. The window is starting to open now, particularly for AI companies. And we are seeing a lot of activity in M&A for AI companies and a lot of activity for IPOs, again, for AI companies. But the fact that most markets have not been doing well after 4 years means that there's a lot of angels who have kind of lost faith and are asking themselves, why should I keep investing? I'm in negative cash flow. I'm putting money out. I'm not getting money back. And the same thing is happening to limited partners in venture capital funds. They're putting increasing pressure on VCs. Where's all my money going? How come I haven't seen returns? This will shift, and this last year, 2025, has already seen some positive developments, but not enough outside of AI for us to start cheering at. But both M&A and IPO have been depressed, except for AI, and 50% of the money in the past year that we've invested has gone to AI companies. And for some VCs, probably 70, 80%.
And what's happening? Are you seeing anything different on the M&A or IPO or the exit scene in general on the AI side?
On the AI side, there's still an imbalance. More money has gone into AI companies than has been returned to AI companies. But it's a brighter market right now because we've seen a number of successful IPOs and lots of M&A in the past year. So that is the healthiest segment regarding exits. And as I've said, if we don't get exit money, we're less likely to keep investing. And there's been a radical shift in venture capital towards mega rounds of $100 million or more. And many of those, again, those are AI rounds. And the money going into venture capital is largely going into experienced managers. There's been a real radical shift there just because of how dismal returns have been really since 2021.
So all of this is adding up to a picture that's maybe not so great for the first-time founder, especially in an area like maybe deep tech or STEM, because on the one hand, angels haven't had any liquidity, so you don't have any extra cash to invest. There's government grants that are very uncertain. And then VCs are kind of concentrating more and more towards experienced managers, large rounds, very sector concentrated in terms of AI, and related fields. What does all of this mean to the first-time founder, and what advice would you give them to say how should they arrange themselves to maximize their chances of getting funding?
Well, cast your net wide and look at non-traditional sources. There are SBIR grants and other government funding that are, the good news is they're non-dilutive. And there are many, many, many different funding organizations and agencies, both here and in Europe. But I would also say one of the most interesting signs of life I've seen is private equity. Private equity wants to be co-investors, particularly in hot sectors. And something like 40 or 50% of all software exits have happened because of private equity buyers, not the traditional strategic buyers of people in your industry. So it's never too early to start making friends with smart people in private equity who like your domain, like your industry.
So even if you're an early stage founder.
They're both investing as well as buying.
Wow. Okay. That's the first time I've heard that. And are there things you would do differently when you're building a relationship with a private equity investor versus a traditional early stage investor?
Another great question. The key thing that private equity looks for that venture capital does not is cash flow. The private equity deals are somewhat different, and it takes positive cash flow to create the kind of leverage that allows a PE firm to go in and invest substantially. So we are less concerned about positive cash flow early on than the private equity people are, but that's where they live and die. And so for them, EBITDA is their governing religion because they want you to have positive EBITDA, which allows them to take out bigger loans for more of your company.
So does it bias them more towards like heavy cash flow sectors like software versus the more capital intensive, lumpy businesses like hard tech or other deep tech, which are very capital intensive? And maybe
Right.
what are your thoughts on that?
No, I think you summarized it well.
So it's still a challenge, right? You still
There
have to
still is
go.
a prejudice for capital efficient businesses. But this is true at almost any stage of the life cycle. This is true of almost any investment regime we're in. We just happen to like capital efficient businesses because there's less capital risk for us. And if things go south, there's probably less dilution as well.
Got it. So I want to talk a little bit on the angel investor side because obviously you have a lot of expertise on that. What are you seeing in terms of the changes in the angel landscape? The old trope was that angels are pale male's tale. It's your dad's. You yourself have referenced Dad's Country Club. What's changing in the angel landscape and what are the implications for
Well,
founders?
okay, first change is we've had a dramatic increase in the number and variety of ways you can invest as an angel. Everything from what are called hero houses, where a funder will create a shared working space for the companies they invest in, and they'll really encourage a kind of kairetsu, let's go along, play along, work together, sell together kind of environment, all the way to organizations providing the complete back office, back end for angels. There's a network called People and Networks, PIN, that provides a complete back office that angels don't have to develop themselves. But the range and variety of creativity here has really exploded. Along with that, there's been an explosion in the kinds of angel groups out there. And we now have lots of angel groups formed around university ties, lots of angel groups founded around ethnicity and race and gender. I can't even count the number of angel groups focusing on women investing in other women. So there's the creativity in the angel world shows no sign of stopping.
Which is great for the angel side and even for founders, but it does provide a challenge because as a founder, I have limited time, limited resources, and I do have some kind of deadline where I need to raise money. So it might be a problem of abundance. So, how would you recommend founders filter and select the right angel groups to work with, especially with this huge proliferation, in the number of angel entities?
So number one is, what outcomes are we both looking for? Are we aligned on outcomes? If the group wants to see an outcome that is an exit in 3 or 4 years, and you believe it's going to take much longer than that to build market share and build credibility, then we have a disconnect there. What kind of markets do we want to focus on? There may be a conflict. It may be that some angel groups only invest in certain markets and don't want you suddenly going from being a dating site to being a Defense Department site overnight. And there are those kinds of issues with angel groups. So is there a match on values? Is there a match on exits? Is there a match on the pace by which you want to structure the investments? Is there a match in terms of the level of control that the angel group wants? And so the chemistry has got to be very, very, very good. And there are some organizations that never replace CEOs and advertise that. There are some that will do whatever it takes to build a strong company fast. So you need to understand all of that. And the most important thing you can do as a founder is to look at the portfolio of the angel group you're thinking of investing with and call some of their existing portfolio companies and ask, how's it going? How's it going? We expect that.
Okay. There's one thing you mentioned here, which is this issue of chemistry, right? Early stage, you don't have a lot of hard data. Chemistry is so important for angels, but chemistry is also the place where bias can thrive. So if I'm I don't know, a non-traditional founder and I'm trying to make inroads and get funding for a very non-traditional kind of business, how do I balance that chemistry with this possibility of bias, especially with angel groups? Any advice?
Um, well, if you were talking to an angel group that's thinking of investing in you, the issue of bias is probably not all that relevant because they're talking with you and they're keeping that relationship going. That issue is much more important when who do you approach in the first place? But if they're thinking of writing you a check, then I don't think the issue of bias is all that important because they've already passed several hurdles, which you can easily check out.
Is there a chance then that I don't make it that far because of potential bias? And if so, how do is there, I mean, I find it hard to say that there is no bias at all. I understand that it may be less in angel networks, which I buy, by the way. but I can't believe that there's no bias. So how do I maximize my chances of getting past any of those invisible, potentially unconscious barriers?
Again, I'm not sure how to answer your question, because how do I get beyond the biases I can't quite see? I'm not sure. Uh, but one of the things you can do is you can look at the portfolio that they have funded and look at that portfolio demonstrates bias or not. And the bias works in all kinds of directions too. It also has to do with the women investors who will not invest in men. So there's bias all around, and yes, be aware of it. But look at the portfolio. That's the proof of the pudding right there.
Got it. So we've talked quite a lot about how to select the right investors, what kind of investors have what kind of motivations. Are there specific questions that we have not covered that you think founders should ask investors before deciding to, proceed further in the funding journey?
Well, my best source here is to talk to the founders, CEOs that the fund or the angel group has funded. What happens when the economy goes south? Have they applied extreme pressure? Have they been follow-on investors when you've needed money? How difficult was it raising that follow-on? And I'd be asking very pragmatic questions about their actual behavior when you need help. Which angel groups actually introduced you to partners or customers? Things like that. And it's the pragmatic questions that really determine how well that relationship is going to go on.
So it feels like it's just a filtered process where you start off with the big list of angels, you filter it down to these are the people who match my industry, my thesis, or whatever, I'm looking for in terms of funding, support, and partnership. And then within that, you start to do your actual due diligence, your reverse due diligence, by talking to founders within their portfolios to say, what is the reality of living with these investors? How
Yeah,
supportive are they?
I think that's a kind of great framework. I advise people to do very humble things. What do I mean? Go to Crunchbase and type in your industry and sector and look at the investors, both VCs and angels, who've been investing in your sector. Look who's on their boards. Invite them out for coffee, not to raise money, but to say, in 6 months, what would I have to look like to interest your angel network or your fund? Again, it's real people meeting people as opposed to having theoretical constructs, and see if that works. And I guarantee you, at least in Silicon Valley, if you ask 3 board members out for coffee, one of them is probably going to say yes out of curiosity for what you're doing.
Okay. I was about to ask you because I'm sure these people's LinkedIn DMs are overwhelmed with random cold messages. So I was just going to ask you if you had any tips that founders can use to increase the odds that somebody's going to say yes.
Yeah, so I get hit with these all the time. I get hit with one last night where someone said, I'm building a company. It's going to do really exciting things. Can I call you up and talk to you about it? And my answer is no, because you didn't respect me enough to tell me what you're doing so I could easily qualify you. Somebody else called me up and said, I'm building a company in health informatics. I'm a professor at Stanford, and I have these kinds of issues and questions. Would you mind working with me? And I gave them an enthusiastic yes, because they had respected me enough to tell me what they were doing. What they were doing is something that relates directly to my interests. And so I said, sure. I don't know who is doing this. One of the incubators or accelerators are telling all of their portfolio to just call up investors and say, can I have a half hour of your time to talk you through my exciting idea, with nothing more than that? Because they don't want to correspond by email. They believe that if it's face to face, I'm more likely to be nice. At the same time, I don't know anything, and I feel that I'm being treated very rudely.
Got it. So it's just a basic amount of
It,
homework on what might be interesting to you and to give you the benefit
yeah,
of.
it's doing your homework. I do not invest in games. I don't invest in consumer side. I don't do e-commerce. Here's what I do. And if you're one of these companies, feel free to reach out. But treat your investors with respect and having done some homework on them.
Got it. One other question of kind of selecting and managing the right investors. And I think thankfully I've not heard too many cases, but I've heard a handful where a VC or some investor says, I'm interested in your business. you go through supposed due diligence and screening, and then you find out later that they have a competing portfolio company in their portfolio. Okay, shame on the founder. You should have found that out first. But what's your take on, is there risk of bad players on the investor side, and what should the founder do to protect themselves to make sure that they're dealing with bona fide parties?
Well, you just said it. Sure, do your homework. This does happen. I don't think it happens all the time, but it does happen. As soon as I qualify, I figure out what the heck the CEO's company does, I will tell them straight out if I have a competing portfolio company, and I will leave it up to them if they want to continue the conversation or not. I do say I will not share anything I've learned with my other portfolio company, but they should know that there is a conflict there. In most cases, they will back out gracefully and say, yeah, this is probably not worth it. Because investors know that their reputation of being IP stealing bad apples, that people are going to stop seeking them out.
Got it. I just want to close out in terms of how to convince or tell your story to an investor in ways that are credible to them. And specifically, I want to talk about deep tech and companies that have high capital needs and long timelines. What have you seen work well, and what kind of approaches should deep tech founders use in applying everything that you've said and in improving their chances of landing that right investor?
Okay. Well, for me, there's still a basic rule that applies to all companies, and that is, do you have customer intimacy? Are you being guided by customers? If so, what do they think? How do they think you're making progress? You are never smarter than your customers, despite the fact that my boss and friend Steve Jobs believed that to be the case. I don't think you can ever be smarter than your customers in the sense of discounting what they want, what their needs are, how they evaluate things. So when a company is making progress, I want to know about the customer reactions, or the advisory board, or your network, how they're reacting to this.
Is that it? Like, what else would you look for?
I would look for product roadmaps that are based on expanding your market as opposed to doing things that engineers like to do. One of the big problems in deep tech is that these are people in love with engineering. And where did the roadmap come from? How do you know what to build? Is that based on custom requirements or things you think might be cool? And it's never all one or all the other, because you do need to be doing some cool stuff too. But if the product roadmap is built by consistently expanding the pool of customers you can sell to, like today, we're kind of weak on security. In 9 months, we'll be able to support HIPAA requirements for medical record security. Well, that's great. I know what you're focusing on and why. So again, for me, it's all about how deep are the customers involved with what you're doing.
Let's say that I take everything that you've said, and typically you only see, let's say, a pitch deck, like some limited amount of information when you're first coming across a new deal, right? A new startup.
Yep.
Let's say it's a deep tech startup. Are there things that you look for before you start to talk to that person that either makes you say, not going to look at it, or this is worth a second look? What should I be focused on as a founder in starting that process of building that relationship with an investor?
Okay, well, absolutely. One of the first things I look at is the product features, product requirements. And I ask, where did they come from? And if the answer is, well, I formed a customer advisory board even this early on, and I'm talking to 3 very related potential customers in the market, and I've validated what I'm doing with them, great. If it's the answer is, Ron, my CTO went to Stanford and he's really smart, that for me is a quick kill. Because again, the requirements shouldn't come because people are overly smart. It should come because people know a market very well and have taken the input from the market.
So that brings me to a question that I've been thinking about for a long time. When you're talking about deep tech and STEM founders, right, a lot of them have very deep technical backgrounds, and they tend to be a little bit in love with the product, which is fine. But there's this tension between, I know the product, and do I really need to know the business side and the market of things? And I've in fact had a debate just this morning with a couple of founders. What's your take on technical founders and how they can overcome that engineering blind spot or the engineering tunnel vision and
So
make themselves...
For years, that's a great question, and we all face it. But for years, I was on the board of an incubator called Milcom, and Milcom took technology out of Defense Department labs and commercialized them. One of ours was a big hits, was a Wi-Fi system for Wi-Fi public access for downtown people by putting them inside of light meters and light stands and stop signs. And how do we get there? By listening to some of the largest transportation authorities in the cities we dealt with about what they would do, what they would support, what they would buy, even at the earliest stage. So what Milcom did was it had people who were outbound requirements validators who would walk up and down, whether it was the Defense Department or an urban transportation network. They would check out the requirements and what we were building with those folks and say, would you ever buy something like this from us? So again, even the word deep tech does not free you from the obligation to evaluate what you're building in the sense of, is there a market for this?
So you look at a lot of these deals from Band of Angels and other investment vehicles, channels. What are the top three problems that you see that are holding deep tech founders back the most when they seek funding?
Well, let me address foreign founders first, because this is a biggie. It's a limited notion of what success means. I spent a week about a year ago in southern Italy for the Italian government looking at business plans. And people thought that success was after 5 years, we would have $1 million in revenue. And so it's underscoping what success means is very common outside of the US and what we might call the extended Anglosphere of Canada, New Zealand, India, Australia, but people playing the same by the same rule book. So that's one big issue. A second big issue is not understanding what motivates investors. What I often do is I often spend an initial board meeting with a new company explaining how angels or VCs get their money back, how we evaluate how likely this company is going to be to return a positive exit to us. And we'll walk them through the way we think about deals, both how we evaluate them and how we calculate our returns. For many, this is a big eye opener. But if you don't understand why we are funding you and what we are looking for, we're not playing on the same team.
So mismatched aspirations in terms of targets and then not understanding investor motivations. Are there others you would add to the list?
Well, and there's the biggest example of this is, for me, the very sad popularity of safes, because safes create a wall between the investor and the founder. Basically, you promise to stay out of the company. We're not going to share materials with you. Your voice is not going to be heard around the boardroom. That's great, right? Mr. Investor, you like that? Send us the money and we'll talk to you in a couple of years. An investor doing that would have to be an idiot, in my opinion, particularly early stage now when you need all the help you can get. So the reason I think safes are counterproductive is because they turn off your biggest source of support, advice, networking, information, and so forth.
Okay, so don't approach your investor with a safe was kind of like the big message that I take away from.
That's right. And what you're telling me is you want nothing to do with the people who gave you money, and you're going to run the company all by yourself with no gray hairs around the table at a time when the gray hairs are absolutely needed. But God bless you.
So we looked at the mistakes that they make, but maybe we flip the conversation. What are some underrated markers of confidence or credibility that you want to see with founders that you don't see as often?
I love founders who are humble. I have lost money with charismatic CEOs because charisma, as I learned after the fact, is highly correlated with people who don't take advice or have a very rigid point of view and don't want to change their beautiful business model, even upon feedback from the market. So I look for humble CEOs who are willing to listen and learn, not from me, but listen to their markets, listen to their colleagues who are constantly looking around and seeing what's going on. Two of my favorite CEOs exemplify this. They were great people, but not masters of the universe. Another thing I've learned is do not confuse pitching with business building skills. You can be a great pitchman and not have a clue how to actually run the company. And so I'm much more impressed by facts on the ground than I am by eloquent pitches, and why I don't even pay attention most times to pitch contests. It doesn't tell me anything.
So, what are the markers and the tells that tell you that somebody is a good business builder versus somebody who is a good pitch person?
Well, let's say it starts with the quality of the business plan, and it starts with where they got their concepts from. So, how did you determine how you're going to sell the product? Well, I looked at one of the biggest players in this related market, and this is how they did it. They hired ex-submariners because the rigorous training of submarine teams is directly related to the rigorous training you need to be a STEM and big data company support staff, customer support. I thought that was absolutely ingenious, and they did brilliantly. But again, teach me something, do something that's real world based, not based on some theory, but show me what you're actually doing and why you're doing it, and learn from your competitors.
Okay, that makes sense. And one related question on that, you haven't talked much about business acumen or financial acumen. To what extent is that a factor for you as you're considering a founder for investment?
I would say that the founder needs to be metrics driven, and that means caring about the most important metrics that drive the business. Does the founder need to understand all of the implications of every piece of a SaaS model? No. That's what the financial team is for. But the CEO ought to love being metrics driven and impose a metrics driven culture on the team. So I'll go that far. If you don't know where you're going, anywhere will take you there. I don't believe that's true, but I wouldn't be anal retentive about it either. But having a healthy respect for the top level milestones you need to achieve to get where you're going, yeah.
Awesome. Got it. So now there's a lot of turbulence in the funding market, right? So there's uncertainty around a lot of sources of government funding, particularly in the healthcare sector. The markets themselves are in a state of flux. Given all of this, what kind of top three pieces of advice would you give to a first-time founder who's looking to go raise money for the first time and build their startup to improve their chances of success?
First, have a business model. It may not be the right model, but it's one you can walk through the assumptions with your investors. Two, related to that, is that for me, teams that are just as excited about building the business as they are about building the product stand out. They're noticeable, and they're more thoughtful than engineering-driven teams who only care about modifying the product itself. Those are two things. And third is, whatever you do, be yourself. Because at the end of the day, this is not a 2-week relationship. The typical path to exit for startups is around 8 years. And we're going to get to know you really, really, really well. Be yourself. No bullshit. No, don't put on airs. Don't be somebody you're not. Don't be the person you think the investor wants to see. Be the person you are, because we're going to work with you for a very long time.
And what does that mean in real life where you've seen founders be themselves versus not be themselves? How does that show up to you in?
Okay, so the kind of founder I hate is somebody who is full of buzzwords, is bigger than life, is arrogant, is overly charismatic, and knows every VC funding term and VC cliche in the book with no depth around his own business. Hey, Ron, I heard you guys have a lot of dry powder. I mean, when I hear a founder talk like that and trying to use VC lingo, I said, here is a phony. I'm not here to test your knowledge of venture capital. I'm here to learn how you're going to build that collision detection algorithm for next gen networks.
Do you actually see founders like that?
In Silicon Valley?
Okay, fine.
That's where I live. This is the land that has the largest cookie cutter creation model for phonies in the world.
I love that. Very refreshing honesty. So if you could boil it down to one mindset shift, right? What should I do tomorrow as a founder that like a foundational shift or a change that will fundamentally improve my chances?
What is your world domination strategy? One of the things we haven't talked about is that at exit time, whether it's by private equity or it's by venture capital or buying you out, or whether it's an IPO or an M&A, the first company with a major exit usually gets as much as half of all the proceeds of everybody else in the market over time. The number two may get another 25, 30%. Number three may get 10 or 15%. It is definitely a Darwinian kind of a model. And I don't want to fund number 14 in the space. So I want to see that you have the drive, the force, the hiring skills, the strategy to be one of those top players in the market. If you're not suited up because you don't like competition much, if you're not suited up to win, I'm not going to win either. Like I said, 5 years from now, I don't want it to be shown that I was funding the 14th major player in a market, because there is no outcome for you or for me.
So it's a singular focus on understanding my market, to your point earlier about having that customer intimacy, knowing the nitty-gritty, and then using that to have a solid business model that will then lead to a very good chance of quote-unquote world domination, right?
And to have the psychology, the flexibility, the listening ability to pivot when you have to, is not to be rigid about, following through, but willing to modify your business as you need to.
And is that, do you believe, an innate trait or something that can be learned? Because, already it feels like you're asking for Superman or Superwoman, right? That's a pretty tall order. So what is the actionable insight for a founder?
Great question. It has a lot to do with your personality. You may be able to learn some of this, learning by coaching or learning by example. And I love CEOs who hire personal coaches to make them more well-rounded people. But to some of this is also inbred and hardwired. And the reason we take a while doing diligence is because we're going to be asking people who know you what you're like under pressure, what you're like. Do you ever change strategies, or do you rigidly stick to the original one until everything is burned through? What have you done in a crisis? The same questions you should ask about us. What's Ron Weissman like when the market crashes? Does he immediately try to sell the company and fire the team, or does he stick with you in some meaningful way? Those are questions you should always ask about us, because we're going to ask them about you.
Got it. We've covered a lot of ground and you've shared some really cool insights, which I really appreciate. I want to ask if there's anything that I should have asked that you would have wanted me to ask, but I didn't ask.
Oh, I'm sure the answer is yes, but the questions you asked are wonderful, and they're really, really rich. They're really well thought out. So I know from experience, Shubha, that you too are a great mentor and a great coach.
Thank you. I try to be.
You are. You absolutely are. You ask the best questions in the world.
Thank you very much.
I hope we accomplished what you wanted to accomplish.
Yes, I'm sure we could talk for another 2 hours and maybe we'll have you back again. But this has been an amazing conversation. I really appreciate the time you've taken to share your thoughts with us, Ron.
My pleasure.
Thank you. And that's a wrap for today. Thank you for tuning in. If you find these conversations helpful in your own journey, please subscribe to Seed to Success, our weekly community letter with tips, insights, resources, and more. If you have any other questions relating to startup finance or financial storytelling, send them over to me at chakras@achieve.co. That's chakras@achiiv.co. We'll see you on the next episode of Invisible Ink. Now, go achieve.